Today I'm going to talk about how you can leverage a whole life insurance policy for a real estate deal. We are going to go through a few models that demonstrate leveraging a life insurance policy to purchase a piece of property, and we'll go over what the policy looks like if I pay the loan back, if I don't pay the loan back, and if I pay interest only. And what we'll look at is the total return when we isolate the policy, so you can see what the net returns are on your policy when you take a loan, account for the loan interest, and then also when you account for the income that is being produced from your real estate investment. So to kick things off, what we typically see with real estate investors is someone has some money sitting in the bank, and it's in the bank specifically for opportunities. So we're going to look at a common case study here, which involves someone that has about $500,000 in cash, and they plan to move this into a whole life insurance policy primarily to invest in real estate. Now, why they move it into a life insurance policy is not for the life insurance, but it's 100% for the cash value. When you look at the cash value, it's a safe place we can put money. It's very liquid. We can access it anytime. And when you access the money in your life insurance policy, it keeps compounding as if you never touched it in the first place. You'll see exactly how that works. And then if we follow IRS rules, it's also tax-free, which is obviously attractive to a lot of people. Now, while that sounds great, there are some drawbacks to the product, which are as follows. The first year is the worst year. No matter how well a whole life insurance policy is set up, you will see a negative hit in the first year. You're going to see that in the model that we go through. Also, a potential drawback here, the cost to borrow can exceed the growth rate on your policy, in particular during the early years. A lot of times this point is just brushed over. It's very important to understand exactly how you can see the net returns and net cost to borrow on a life insurance policy. And then lastly, this is where most people go wrong. If a policy is poorly designed, or you pick a company that just does not have a track record of delivering strong cash values to policyholders, that's often where we see buyer's remorse. So let's look at a whole life insurance policy. We'll look at how it's set up. I'll talk about how to look at the net growth rate and net cost to borrow, and then we'll start to look at the loan models. So what we've got here is a whole life insurance policy with Mass Mutual. It is on a 50-year-old male. At the end of the first year, he's 51. He's moving a total of $500,000 into a policy. You're going to see that he does this over a 4-year period. $125,000 per year for 4 years equals $500,000. Now, when we look at the cash value, here you go, net cash value, just about $112,000 in the first year. If it was $112,500, that would be 90% of his payment. It's just about there. It's still a loss. He takes more than a 10% loss in the first year. That is one of the drawbacks to whole life insurance. The first year is the worst year, and it takes a few years before I even get my money back. For example, by the 4th year, I've paid a total of $500,000. It's not until the 4th year in this example that I finally get my money back. So I have these startup costs. To illustrate, I could be interested in purchasing a piece of property. I like using a whole life insurance policy because I can borrow against it while the money keeps on compounding. There's no fees or long wait periods to access my money. However, the startup cost is that I take about a 10% hit in the first year, and it takes a few years to get my money back. If I'm okay with that, it can work beautifully, especially when I look at it from a long-term perspective. If I'm not okay with it, I probably shouldn't do it, but I want to be aware of it up front. So after the 4-year funding period, he pays 0, and that cash value just keeps on growing. Now, this particular example is with Mass Mutual, and Mass Mutual's 2025 dividend interest rate is 6.40%. Does that mean that your cash value is growing by 6.40%? My answer is, I wish. It's not. So what we've got here is the same illustration we just looked at. There is your first year cash value, $111,000 and change, and there's your break-even point of year 4. Okay. Dividend rate, gross. I always say gross because people see this dividend interest rate on a whole life insurance policy and think that is what their money is growing by. And then when they find out it's not, they get upset. I get it. I would be upset too if someone told me that. I'm not telling you that your money is going to grow by the dividend rate. That is the gross interest rate on a policy that's applied to your policy after the insurance expenses. What we want to look at is our annual yield. If I request this on an insurance company's illustration, this will sometimes be referred to as the yearly rate of return, or the 1-year cash value growth, and some companies will include the rate of return here. But that is the net return year over year. It's negative 10.6% in the first year because you paid $125, you have about $112. That's a loss of just over 10%. Now, growth in dollars, negative $13,000 in the first year because, again, I took that loss. Now, as each year passes, you'll see that it gets better and better in terms of the cash value growth and the annual yield. And just to be very clear here, this is not factoring in your payments. This represents what you're getting every year from the insurance company. Okay, so what we're looking at here first is maximizing the growth of your whole life insurance policy. Next, we're going to look at how to measure the cost to borrow. What drives me nuts is when people say, look, you can put your money into this whole life insurance policy and earn a dividend rate of 6.40% and then borrow against it at 5.67%. That is almost a 1% spread. If we look at it, that's about a 70 basis point spread if we do nothing else. We have no, because that is not how it works. But when someone hears that, they believe it. And when I look at the percentages on paper, it makes it look believable. However, it doesn't work like that because the dividend rate is not what we are actually earning on our policy. What I would want to look at is this, the annual yield compared to the loan interest rate. Now what do you see? Well, that annual yield never hits the loan rate. Now, this was run in May of 2025. If we run this in June of 2025, as time passes, it would be slightly in favor of the annual yield. It is a variable loan interest rate. It changes every year for the policyholder. What we can look at to make life easy, though, you can look at the percentages, but I don't like that because you earn that annual yield on your entire cash value and you pay interest only on the amount that you borrow. So what you can look at to make life very, very easy is what you are earning every year in dollars and compare that with what you're paying every year in dollars in terms of loan interest. So we'll look at that in a little bit. Let's look at it in our case study. Here's what we're going to look at. We'll assume that you have cash value of about $500,000 that is generated from the payments you made of $500,000. We're going to look at that exact illustration we just walked through. You see a deal that requires $300,000 of capital to purchase. You want that deal because you do the math, because you are a very sophisticated real estate investor, and see that you can earn 10%. So the terms of that comes out to $2,500 per month or $30,000 per year. That is what this particular property is going to cash flow you. The returns on the property can be anything. We just plug the real estate return into the model. You're going to see the model in just a few minutes. So, to get that policy, here's my plan. I am not going to go to a bank or lender, so I don't have to deal with any underwriting, credit checks, tons and tons of paperwork, none of that stuff. Instead, I'm going to take a policy loan. When you request a loan from a life insurance policy, you typically receive the funds by direct deposit in 3 to 5 business days. There's no credit check, there's no impact on your credit score, you get the money quickly, and you set the payment terms. You can pay it back however and whenever you want. You can even not pay it back at all, not even the interest, and I'll show you that model as well. But what we're going to do here is take that policy loan of $300,000 to make the investment, which means we're going to purchase that property. The property is producing $30,000 per year, so we're going to take that $30,000 per year and use it to repay the policy loan. The question I would have if I am you is, what does my net return look like in this model? And specifically, is it better than what I am already doing now? The answer is yes, and you'll see that in a few minutes. But the end result is that I have my investment, which is my real estate here, and my policy kept compounding for me the whole time, which is why people do this. So here's how we like to analyze the numbers to make sure they actually work in our favor. We want to take a deep dive into the policy growth, which we already did, and then compare that with policy loans. First, we'll look at the worst case scenario. What does it look like if I take a $300,000 loan from my policy, purchase this deal, and then I did not do proper due diligence and the whole thing blew up and I can never pay anything on that policy loan again? What will happen to my policy? Will I lose money here? It's important to look at this kind of stuff, which we'll start with that. Then we'll look at the same scenario, but assuming we pay interest only forever. Then we'll look at repaying the loan with the $30,000 per year in cash flow. And then we'll look at repaying the loan faster, as a lot of people we work with will do this whenever they come into lump sums or have excess cash. They'll just throw it at the balance to quickly pay it down. So we've got the different illustrations here. This was the growth one. Here's a loan example where we pay nothing back. You can see that here because that loan balance compounds. Then we've got paying interest only, paying it back faster. Let's look at these in Excel because these illustrations are kind of like stereo instructions. There's a lot going on there. But I promise all the numbers you're about to see here are pulled directly from the illustrations we just saw. So to start, what does it look like if I borrow and don't pay anything back at all? Here we go. So what we've got on the left, growth. Anytime we look at a loan, I'm a huge fan of looking at my growth illustration to the left. This way you can see exactly how much your policy is impacted the year you take out a loan, and then also long term, because I can compare. Here's my cash value before loan, here's my cash value after loan. So in this example, in the 5th year, when he is 55, is when he takes that $300,000 loan. What's the impact on his policy? Here we go. There's your cash value, 208 and change, and there's your death benefit, 1.757. The death benefit is 1.757. What was it before you took that loan out? $2,057,000. After you took the $300K loan, your death benefit was reduced dollar for dollar. You'll always see that happen with a whole life insurance policy, regardless of what company your policy is with, which is really nice. So a drawback to policy loans is that your death benefit is reduced dollar for dollar. Another drawback is that you do have loan interest that is due. So in this example, we're not going to pay the loan interest at all. And if you don't pay it, how it is paid is your policy is going to process a loan against the cash value to cover that loan interest. Because a loan is processed, that's why the loan balance is going up. And then your death benefit will be reduced by whatever the total loan balance is. I know that's a lot. Here's the bottom line I would look for. If I take this loan and never pay anything back, does my policy lapse? Meaning, do I start to see my net cash value go down year over year because the total cost to borrow, the loan interest, exceeds my cash value growth? That's my question. And an easy way to look at it before we get all fancy here is by looking at this column on an illustration. We can go back to the PDF if we want. You don't have to have it on Excel. But if you're looking at your PDF or on Excel, just look at your net cash value column. And if you're looking at it on Excel or any spreadsheet from your agent, I would cross-reference it with the actual illustration from the insurance company to make sure everything is accurate. So it's going up there. That is something we can look at and use just as a stress test to know it's okay. But let's look at the actual results here. So to look at the net results, what we look at is our cash value growth, which is the same figure we looked at over here. Remember the dividend, annual yield, then the cash value growth? That's what this is. It's showing you what your cash value is growing by net year over year. Then we've got the loan interest. This is the loan interest that is charged by the insurance company every single year. So what I would want to look at here is the net return. Policy return, we could also call this spread, which is simply the difference. All right. So if we look at year 6, which is the first year, interest was paid, not out of pocket, but paid internally by the policy. What does it look like? Well, my money grew by $24,000 and change. The interest charge was $17,000 and change, which means the net result was about $7,200 in terms of total earnings there, which when I look at the cash value growth, it's going to be right around that figure when I look at the growth year over year. So the net result here, where the policy return is showing the net result just inside of the life insurance policy. We have not factored in the real estate yet. The reason I like to do this first is because if I plan on using the policy for real estate, I want to see if I just take a loan and don't pay it back or pay it back whatever, does it actually put me in a better spot than using cash or any other method? Meaning I don't want to see this go negative. Otherwise, it doesn't make sense, which can happen if the policy is not set up right. But again, this is just the policy return. Now, let's add the real estate investment. So what we do here is we take the policy return. This is the same thing right here. These columns are identical. And we purchased our property at 55 in this example. And then we're assuming it begins to produce income the next year at 56. And the real estate income, in this example, 10%, is $30,000 per year. If you're a real estate investor, what are we not accounting for here? A lot of things. Appreciation on the real estate. What if we increase the rents? What if we can yield a higher return as the years pass? There's a lot. This example is meant to be simple. All right. Policy return plus the real estate income gives me my net return. And remember, what are the 3 core benefits of the cash value in a life insurance policy? Safety, liquidity, tax-free if we follow IRS rules. So the growth inside of the policy, as it's growing, we're not dealing with taxes. As long as we don't lapse the policy with a gain or trigger a modified endowment contract, we can access that tax-free, which is nice. Now the real estate, if I normally had to pay taxes on that, I still would pay taxes on that. But if I'm looking at this in terms of percentages, my net might be higher because of the tax benefit that comes with the life insurance policy growth. So that demonstrates paying no loans at all. Let's take a look at paying interest only. So we've got the growth model. Then we've got the exact same scenario. We take that $300,000 loan. Notice here, the loan balance never goes up. The reason why in this example is because we are assuming we are making a loan payment every year of $17,000 and change, which is the interest that is charged. So in this example, every year the interest is charged, we're assuming that you are paying it out of pocket, not allowing the policy to pay for it internally. And what this will do, if you look at any point in time, let's go all the way down to when he's 80 years old. In the example with no loans, his death benefit, $2.18 million. In the example with loans, take 2.18 minus 300, and it gives you 1.88. Death benefit without any loans, minus loan, equals net death benefit. So that's the example. Assuming that you pay interest only, here's your policy results. Cash value growth minus loan interest gives you the net policy return in dollars. Again, this is looking at the net return on a year-to-year basis. What we're not doing in this video is looking at the cumulative return, which would actually make everything look better because it's in favor on a year-to-year basis. So that compounding is going to continue to balloon your overall returns if you're looking at the total returns. Most real estate investors I've spoken with over the years prefer to look at the returns on a year-to-year basis. So here we go. Here's the policy return. And again, this is showing the net here. Cash value growth minus the loan interest gives you the net. Then we'll factor in the real estate income. And this one, aside from this year, every year after, will look stronger and stronger. Why? Because I am also receiving the real estate on top of the policy return. So if I go back to the last model, look at year 10, your net return here in this example, where you pay the loan interest, $45,000 and change. In the last example, if I go to year 10, my net return, $41,000 and change. I made more money, or I earned a higher net return in the example when I paid the loan interest. The reason why is because the loan was compounding in the first example. I wasn't paying it. Whereas in the second example, I was paying the loan interest, which prevented it from compounding, which gave me a higher net return. All right, let's look at the last example. Here we go. Growth on the left, loan and repayment on the right. Here we go. Here's your $300K loan. There's the impact on your policy. In this example, we're going to take the $30,000 per year that our real estate is producing and repay the loan. So $30K net year over year. There you go. And you can see how much is applied to your loan interest every year and how much is applied to your loan principal every year. Do you like seeing that? I do when I can see a breakdown of exactly where my money is going. So in this example, at paying it down $30K per year, it's paid off at year 21. At that point in time, your cash value, 1.2 million, death benefit, just over 1.5 million. If you compare that with the example where you just let it sit and grow, it's worth exactly the same. Why? In case you're new to this. When you take a loan against a life insurance policy, you continue to earn dividends and interest still on your entire cash value. Now, there are terms called non-direct and direct recognition. Direct recognition can have a slight impact on the growth, but it's not major. Typically, direct and non-direct, if you do research on that, you'll hear differing opinions. They work out to be the same when I look at the actual results on actual policies, not just illustrations where I try and manipulate it to make one look better for the one I want to sell. We don't do that, but we see that occur a lot. Anyway, when I borrow and repay, everything's restored. So here's my policy results. In this example, cash value growth, consistent. Loan interest is going to come down in this example because I'm chipping away at the loan principal every year. And then as a result of the loan interest coming down, my policy return is going to get stronger and stronger. And by the way, when that loan is paid off, your policy return is the cash value growth, because that's what the policy is growing by each year. We just want the policy return or the net spread in a situation like the one we see here where I've got loan interest outstanding. But then we start to add the real estate to it. Pretty cool, isn't it? When you start to really build these models out, and we do this for people we work with. So we can do this very, 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 very easily. The only thing we would need from the client are the real estate details as far as the returns that they're currently earning or the projected returns. And then we take their policy and plug it right into the model. When I say plug it into the model, we've got a loan workbook that clients can play with. These illustrations we see here were run in the insurance company's actual illustration software, which we would definitely want to do to make sure the numbers are as accurate as possible. And then we've got the last model, which entails paying the loan down faster. So in this example, we're going to pay the loan at $50K per year, which now you see your principal is being paid down way faster. Here, he pays it down by 63 instead of 71. And the cash value and death benefit are 100% restored to exactly what they would have been as if he never touched it in the first place. And his money just keeps on compounding, and those net annual returns, since he's leveraged the policy for real estate, looks better and better. That is how people we work with tend to leverage their whole life insurance policies for real estate deals. I hope you enjoyed this video. Please let me know your thoughts. If you'd like to see more case studies like this with smaller or larger policies and or real estate deals, let me know. This is one of my favorite things to talk about. I'm always happy to put case studies together. If you'd like to look at some personalized models, feel free to reach out. You can visit our website, ibcglobalinc.com. You can also let us know in the comments below, or you could DM me, preferably on LinkedIn, and I would be happy to talk all things finance and cash value life insurance with you. With that said, thank you so much for watching this video all the way through, and as always, I hope this helps.